Hey guys, welcome back to another episode. In this video, we will discuss the MACD money flow index trading strategy, which has proven to be one of the simplest and most versatile trading strategies applicable to the Forex, stock, and cryptocurrency markets. Once again, it's crucial that you become proficient in the MACD money flow index trading strategy because it has been proven highly effective in generating maximum profits in any market conditions. But before we dive into that, please hit the subscribe button and turn on the notification bell so you don't miss any of my latest videos. So, without further ado, let's jump right into the video. As the name of this strategy suggests, the MACD Money Flow Index strategy, let's begin our discussion with the Money Flow Index or MFI indicator. So, what exactly is the Money Flow Index? The Money Flow Index, or MFI, is an oscillator that utilizes price and volume to gauge buying and selling pressure in financial instruments. This Money Flow Index indicator combines momentum and volume by employing the RSI formula. One can easily calculate the money flow for a trading day by knowing the typical price and trading volume. Traders can compare the results between previous and current days to assess changes in value. This function is also valuable in comprehending the risks and rewards associated with investing in global equities. If prices are higher for the current day compared to the previous day, it generates an uptick indicator, signifying a positive and buyer-driven market. So, when the MFI line is ascending and above the 50 level, it indicates that the market trend is bullish. Conversely, if prices are lower for the current day than the previous day, it generates a downtick indicator, representing negative price movement in a seller-dominated market. So, when the MFI line is descending and below the 50 level, it signals that the market trend is bearish. Using the MFI indicators method for determining bullish and bearish trends, we can employ it as a tool for entering the market. Specifically, when the MFI line crosses from below to above the 50 level, it is an opportune time to enter the market by opening a buy position. Conversely, if the MFI line crosses from above to below the 50 level, it is the right time to enter the market by opening a sell position. Of course, these are fundamental rules. We require additional filters that can work in conjunction with the MFI indicator. The aim is to enhance the probability of success with every position you open. The most suitable indicator to work in tandem with the MFI indicator is the MACD and the 100-period EMA. So, what exactly is the MACD indicator? The MACD, which stands for Moving Average Convergence Divergence, is a momentum oscillator employed for trading trends. The MACD essentially measures the gap between moving averages and assists traders in determining the direction of a trend, as well as whether the bullish or bearish momentum in the price is gaining strength or weakening. How does the MACD work? The MACD indicator operates using three components. First, the MACD line. Second, the signal line. Third, the histogram. The initial line, referred to as the MACD, represents the disparity between two moving averages, typically the 12-period EMA and the 26-period EMA. It's crucial to grasp the distinction between MACD the indicator and MACD the line. The second line, known as the signal line, is the moving average of the first line, usually a 9-period EMA. To put it another way, it's the moving average of the MACD. This implies that the MACD line is considered the faster line, while the signal line is seen as the slower line. When these two lines converge, they are described as converging, and when they move apart, they are diverging. The disparity between the two lines is depicted on the histogram. If the MACD histogram is above the zero line, it signifies an uptrend. Conversely, if the MACD histogram is below the zero line, it indicates a downtrend. From my explanation of the MACD, you can likely conclude that there are similarities between the MACD and MFI, namely providing information about uptrend signals and downtrend signals. Although they use different formulas, both indicators offer reasonably accurate uptrend and downtrend signals. Therefore, to enhance the accuracy of our signals, we should combine information from both indicators. Next, we must conduct a market trend analysis based on price movements in the market using moving average indicators. Moving average analysis. Moving averages stand out as one of the most valuable indicators in the financial markets. You can employ the moving average indicator to analyze a wide range of financial markets, including Forex, stocks, cryptocurrencies, and commodities. Among the various types of moving averages, the exponential moving average, or EMA, consistently delivers the most reliable results for trend identification. In this strategy, we utilize the 100-period EMA because it strikes a moderate balance and pairs effectively with the MACD and Money Flow Index, or MFI. As per the well-known rule among traders, a market is considered bullish when prices reside above the 100-period EMA, and it's deemed bearish when prices are below the 100-period EMA. Now, let's delve into how to combine these three indicators to generate the best trading signals with a high probability of success. Buy signals. The first consideration in determining market trends is to observe the price movement's position relative to the 100-period EMA. For a bullish trend, prices must be rising and positioned above the 100-period EMA. So, as long as prices remain above the 100-period EMA, even if they exhibit temporary downward movements, these are viewed as corrections and are expected to eventually resume the ongoing bullish trend. As you can see on this chart, when prices move above the 100-period EMA, it indicates that the market is in a bullish condition, and our primary focus should be on identifying the most appropriate buy signals. The next step involves gauging the strength of the trend. In this strategy, we only engage in trading when the market is genuinely in a strong trend. Because when the market is in a strong bullish trend, our chances of success increase significantly, and our buy positions are likely to yield victories. Alright, I will now explain how to determine that the market is indeed in a strong trend. One of the easiest ways to determine that the market is in a strong bullish trend is by using the MACD indicator. As I explained earlier in this video, when the MACD line and the signal line move apart from each other, it signifies a strong market trend. Conversely, if the MACD line and the signal line converge and move sideways, it indicates a weak market trend, which implies a lower probability of success when opening positions. Now, let's explore strong bullish market conditions. From these examples, you should clearly understand how to differentiate between a strong and weak trend using the MACD indicator. Next, we will discuss trading signals, which determine the optimal timing for entering the market and opening buy positions. Money Flow Index, or MFI, is the best trading signal. The Money Flow Index indicator combines momentum and volume using the RSI formula. Therefore, MFI is often more accurate and easier to interpret in terms of providing trading signals compared to the RSI indicator. If prices are higher for the current day than the previous day, it generates an uptick indicator, signifying a positive market sentiment driven by buyers. So, when the MFI line is ascending and positioned above the 50 level, it indicates a bullish market trend. Now, the question arises. What is the optimal period to use for the MFI indicator to provide accurate trading signals? The answer is a 4-period setting. We derive this number from dividing the 12-period fast EMA of the MACD by 3. We choose 3 as the divisor because, in our observations, the market tends to experience trend changes approximately 3 times in a single day. Furthermore, we have noticed that this trend shift tends to occur about 3 times in a week. However, if you have a different perspective on the number of trend movements, you can use a value that aligns with your observations. So, how do we go about opening positions using the MFI indicator? As you can see on this chart, the market price here is ascending and consistently staying above the 100-period EMA line. Furthermore, you can observe that the MACD line and the signal line are diverging, indicating a strong bullish trend. The next step involves waiting for a minor correction, which is indicated by the MFI line dropping below the 50 level, while the MACD line and the signal line remain divergent. We will execute a buy position once the MFI line climbs back above the 50 level. As a general rule, it's advisable to place a stop loss at the nearest swing low. Bearish trend. The first consideration in identifying market trends is to observe the price movement in relation to the 100-period EMA. In a bearish trend, prices must be declining and positioned below the 100-period EMA. So, as long as prices remain below the 100-period EMA, even if they exhibit temporary upward movements, these are viewed as corrections and are expected to eventually resume the ongoing bearish trend. How to initiate a sell position using the MFI indicator signal. As you can observe in this chart, the market price here is declining and consistently staying below the 100-period EMA line. Furthermore, you can notice that the MACD line and the signal line are diverging, indicating a strong bearish trend. The next step involves waiting for a minor correction, which is indicated by the rise of the MFI line above the 50 level, while the MACD line and the signal line remain divergent. We will execute a sell position once the MFI line descends back below the 50 level. As a general rule, it's advisable to place a stop loss at the nearest swing high. Based on everything I've explained, you can conclude that all the indicators within this trading strategy serve a highly effective analytical function and complement one another. By leveraging the specific features of the 100-period EMA, MACD, and 4-period MFI, we can thoroughly and precisely assess the market. Therefore, it's entirely reasonable to consider the MACD Money Flow Index trading strategy as an exceedingly reliable approach. The most critical aspect is your adherence to the established trading rules. Avoid entering the market prematurely if all the trading rules are not met flawlessly. So, if you already possess the Money Flow Index indicator, you essentially have a potent tool to succeed in the stock, Forex, and cryptocurrency markets. This can be accomplished by implementing the trading strategy we've just discussed in this video. However, if you don't have this indicator yet, I'm offering it to you. You can download the indicator from the description below this video. I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.